Hey everybody, Smart Silver Stacker here. Hope you're doing well. So earlier this week, Federal Reserve Chairman Jerome Powell told us that we can expect two more rate hikes before the end of 2023.
A strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year.
Now, this could mean a huge problem for the US economy because we have just way too much debt, way too much leverage in this economy to withstand higher interest rates for much longer. And this economy is already on the verge of breaking. But in the short term, if we do see Powell continue to hike, it could mean that we see a sell-off in these markets. I mean, the Fed is one of the primary factors driving markets in this artificial economy. It's even possible that we could see a sell-off in asset prices and a decline in the silver price and the gold price. But if we do witness something like that, I will be taking advantage of it to stack more hard assets at a lower price because ultimately, more rate hikes means we are headed for a stagflationary nightmare. And it could even mean that we're headed for a total economic collapse. And we're going to talk about some of the reasons in today's video. So stick around. Buy your gold and silver from SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. So, why is Powell talking about hiking rates two more times before the end of 2023? Well, a lot of it has to do with inflation, the Fed's inflation fight, because core CPI has remained stubbornly high. You can see here it's still above 5%, so still above the current federal funds rate. And that means could very well be remaining high for some time. Now, that's no surprise to anybody who has been watching this channel. I mean, the reason inflation is so high is not because the Fed hasn't hiked rates fast enough. It's because the Fed bought nearly $9 trillion worth of US Treasuries and monetized a tremendous amount of debt and kept interest rates far too low for far too long. But that doesn't matter to Powell. He is going to potentially implode this artificial economy as he continues to hike rates to try to bring this inflation down. I mean, never mind the fact that we still have tremendously inflationary fiscal policy in Washington and at the federal level. No, none of that matters. Powell just wants to hike rates to get this under control. And, one of the things that we hear from the Fed a lot is that they are data dependent. And if that is the case, and it seems to be so far, that basically means that if inflation stays high, they're going to be hiking rates more and more. And inflation is very likely to remain high and perhaps even move higher before the end of the year. One of the reasons that we have seen inflation come down at all, not in the core, but in the broader CPI, is the decline in the price of oil. I mean, just look at the 1-year chart of oil and you can see how much it has come down from its peak. It's a huge move. And, possibly before the end of the year, we may see that trend reverse. I mean, the IEA has forecast that there will be a lot of demand growing in China and in the Middle East, and that could lead to higher oil prices by the end of the year. And so that will just compound this already high core CPI that has remained stubbornly high. So it is very likely that the Fed is going to continue with these hikes. But one thing we can observe is that they are hiking rates at a slower pace now. And I do think that that is an important signal. It's a bit of a tell from the Federal Reserve. I mean, if we look at this chart of the federal funds rate, you can see that the curve is flattening out significantly. The trajectory is still upward, but the pace of these hikes is slowing down a lot. Now, why is that the case, despite the fact that inflation remains high? Well, one of the reasons that Powell has told us is because he is concerned about further pain in the banking sector, about the tightening of credit in this economy. After all, we are already in the midst of a bigger financial crisis than 2008. And if you just look at the size of the banks that have failed this year, it is greater than all of the banks that failed in the great financial crisis of 2008. So certainly there is good reason for Powell to be concerned about that. He's also stated that one of the reasons they've slowed down the pace of rate hikes is because of monetary policy lag. But I don't really buy that one. It's kind of interesting that he says that because if Powell understands that there is a lag in monetary policy, you got to wonder why he didn't begin hiking rates sooner when inflation was on the way up, instead of just repeatedly calling it a transitory phenomenon. If he knew that it was going to take time for hikes to have an effect. But that is what he's telling us. He's saying that there's a lag to monetary policy, so that is why they have slowed down the hikes. But I think it has a lot more to do with his fear of what could happen in this economy as the Fed continues to move further with their inflation fight. But today I want to go over some of the reasons why I do believe that, despite the fact that Fed Powell is talking a pretty hawkish, tough game here, I believe that when push comes to shove, the Fed is going to have no choice but to return to an easier monetary policy, to pivot, to cut rates, and to go back to quantitative easing. And, ultimately, this means that I think they're going to be sacrificing the purchasing power of the dollar to try to keep this economy together. Now, the first reason is pretty obvious. It is just the absolutely staggering level of debt in this country. I mean, we've got $32 trillion of national debt now. We've got record high credit card debt. We have record high student debt. And the problem is that when you have this tremendous level of leverage and indebtedness, when rates go up, the interest payments on all of that debt moves up too. Just look at this chart from the St. Louis Fed of interest payments paid by the federal government. I mean, this chart is basically going exponential here. And as the debt continues to pile up and rates move higher, the interest on the national debt, very likely it could soon overtake Social Security, Medicare, and defense spending and become the single highest expense in the federal budget. And I do think that when that happens, that will be a bit of a watershed moment of sorts. And that is exactly where we are headed on this trajectory. Now, the second reason also has to do with the debt. And I mean, debt and interest rates obviously are inextricably linked. And the second reason here is the massive deficits that the federal government continues to run and their need to sell more and more debt, and the effect that that is having in this environment on Treasury yields. So the federal government, they continue to finance just absolutely huge levels of spending by issuing new debt. And now that we have seen the debt ceiling suspended, this is going to become a massive problem very quickly. In fact, according to a recent report in Reuters, Deutsche Bank strategist Stephen Zeng, he forecasts an additional $1.3 trillion in debt issuance at the U.S. federal level by the end of the year. And the problem is that at the same time that we're selling all of this debt and we're ramping up the deficit spending and the borrowing, there are major foreign holders of U.S. debt, such as China, that are dumping hundreds of billions of dollars of U.S. treasuries. They are selling those onto the market. So that is competition to the Treasury. If you combine China's holdings with Hong Kong's, which the CCP controls, they have almost $1 trillion worth of U.S. debt that they need to sell down. It's such a serious problem that Congress recently warned Janet Yellen to come up with a plan in case China dumps that nearly $1 trillion worth of U.S. debt. And then at the same time, we've also got the Fed. They're trying to shrink their balance sheet with quantitative tightening. So now they are also net sellers of U.S. treasuries. They're trying to unload this massive $8 trillion plus balance sheet of bonds that they've bought up over the past decade plus. And all of this debt selling, it's a recipe for skyrocketing treasury yields, skyrocketing interest rates on U.S. bonds, because as all of this debt floods the market, in order to entice buyers to pick up new U.S. debt from the Treasury, the yields simply have to move higher. Now, why are higher yields on Treasury such a massive problem? Well, we already talked about the skyrocketing interest costs of the federal government, so that is part of it. But also, you've got to keep in mind that the banking crisis that started in March, it was kicked off because Silicon Valley Bank was forced to sell its low-yielding treasuries at a massive discount to their face value. Now, the way that bonds work is that as bond yields rise, existing bonds that have a lower interest rate, they depreciate in value. So these bonds that the banks picked up when rates were extremely low, they have lost a lot of their value because the yield on them is very low. And if depositors withdraw cash from the banks, and they are forced to sell these assets to make good on the deposits, they're going to have to sell them at a huge loss. Back in March, Fortune reported that U.S. banks were sitting on $1.7 trillion in unrealized losses on these low yielding treasuries. And if we see bond yields move higher from here, that's going to make these balance sheets at these banks look even worse. That is why the Fed ultimately can't really let that happen. So, how do they stop yields from soaring? Well, they stop with the rate hikes, and more importantly, they stop the quantitative tightening, and possibly they may even have to return to quantitative easing in their role as the buyer of last resort. If they buy up a lot of U.S. debt, that will drive interest rates lower, but that also means that they're going to be expanding their balance sheet more. And, this is basically just debt monetization. It's what we've always known QE was all along, but, the central bankers have been denying. It's Banana Republic style stuff, folks. And after seeing what happened to the Fed's balance sheet post Silicon Valley Bank, post banking crisis, they introduced their bank term funding program and they snapped up billions of troubled bonds onto their balance sheet as collateral for bank loans. This is basically just QE by another name. I think it's pretty clear after witnessing that they will abandon their rate hikes, they will abandon QT if they're forced to in order to save the banking sector. Now, the third reason at play here is global de-dollarization, because in addition to the very ugly domestic debt situation, we have this massive list of countries who are attempting to distance themselves from the dollar, and the list is growing. We just had the IMF director for Russia, Alexei Mosin, state that the weaponization by the West of the dollar in international trade and finance makes the fragmentation of the world economy not only inevitable, but also irreversible. So, and the de-dollarization trend, it really is a Pandora's box of some sort, because once de-dollarization is out, it's going to prove impossible to put it back into the box. I can't think of a single example throughout history of a global reserve currency that declined in some kind of a significant way and then managed to gain that ground back. It just doesn't really happen. And if the dollar loses its global reserve status, it's very unlikely to regain that status, because the factors that led to its adoption as the world reserve currency, they just don't exist anymore. Remember, when the Bretton Woods Agreement was first created, the dollar was backed by gold, and the US also had most of the gold. But nowadays, the dollar, it's nothing more than a paper fiat coupon. It's been abused and devalued for over 50 years. And also, the U.S., we're basically broke. We've got $32 trillion in debt, a growing deficit. If you wanted to back up the entire M2 money supply with the U.S. gold supply, it would have to be something like $80,000 an ounce. We've just created this absolutely massive amount of paper fiat currency. And the problem is, at this point, the thing that is really propping the dollar up is a network effect. It is just the sheer number of entities who use the dollar. That is what is supporting the value of the dollar, because people use the dollar, countries use the dollar because it's convenient. Everybody else uses it. We've got the petrodollar system. That's Saudi Arabia and OPEC. They're selling all of their oil in dollars. So if you want to buy from them, you need dollars. The fact that most commodities are still priced in international markets in dollars. So if you want to buy stuff, you need dollars. But as that network effect is diminished and more players drop the dollar, the base of power that the dollar relies on, it's being slowly eroded. And there are just examples of this absolutely everywhere. We have seen Brazil and China dump the dollar for their bilateral trade. We've got Latin American countries moving away from the dollar. We've got the BRICS nations. They're going to probably be unveiling an alternative currency, possibly a gold-backed currency, next month at their 2023 annual summit. We've got Iraq, who's dumped dollars for its bilateral trade with China, who happens to be their biggest trading partner. We've got the ASEAN nations. They're moving away from it. We've got the ACU. That's a group of 9 Asian central banks. They just dumped the dollar-based SWIFT system. The list is really growing rapidly. And this trend of de-dollarization, it has seen a massive acceleration this year in 2023. And, this de-dollarization, it's going to have multiple effects, all of which could affect the Fed's rate hikes. On the one hand, the dollars flowing back into the US from these countries who don't need them anymore because they're not using them as much, that could actually contribute to higher inflation. So, from that aspect, the de-dollarization could be a factor that would encourage the Fed to continue the rate hikes. But at the same time, the problem is that as more countries dump the dollar, that's going to mean even less international demand for U.S. treasuries around the world, because these countries, they're not going to need to find a place to park their greenbacks anymore because they just won't have any. So that means higher rates here in the U.S., higher treasury yields, and more risk of an economic crisis as a result, as we just discussed. And really the lesson to me here is that you just simply cannot continue to borrow vast sums of money and export your inflation around the world forever. It's just not sustainable. And unfortunately, that's exactly what we have been doing for decades now. But it looks like this system, it may be coming to an end relatively soon. But the powers that be, they didn't get the memo. So they're just going to continue to drive us straight off of this economic cliff. And it's not like this hasn't happened in the past. In fact, this is the typical fate for a fiat currency. But, people have short memories. And when this economic crisis finally manifests itself, this currency crisis, this debt crisis, whatever you want to call it, and the Fed ultimately is forced to print or let everything collapse, my money is it's on them printing. I think it's the safe bet. That is almost always what central banks do. They have one tool that's a printing press, and they like to use it. And when this happens, I anticipate that the dollar will tank as a result. And the precious metals, they're going to be the one asset, the one safe haven that everyone is going to want to get their hands on. But what do you think? Can the Fed keep hiking rates without destroying the U.S. economy? Or will they be forced to capitulate as a crisis forces them to return to quantitative easing and rate cuts? Leave me a comment down below to let me know what you think. Thanks for watching, everyone. Stay safe and happy stacking. Don't forget to like, comment, and subscribe, and I will catch you next time. Smart Silver Stacker, out.